Ladies and gentlemen, it is my greatest pleasure and honor to deliver a presentation on the topic of fundraising practice. My name is Pichmonita Ho, a local consultant from Cambodia. I am delivering this course in the hope that at the end of the lessons, you will be able to 1. Understand the financing concept and the 3 key stages. 2. Explore various funding opportunities in Asia. 3. Establish a funding plan and identify which type of business is ideal for each funding. This course is divided into 3 modules. Now let's begin with the first module, financing your business. Before we are getting deeper into the topic, let me introduce you to the concept of financing. If we talk about financing, the definition may vary from one another according to the context it is put in. Financing can be defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. The term financing itself is very broad. However, for the purpose of the course today, financing is defined as the process of providing funds for business activities, making purchases, or investing. It can also refer to a way to leverage the time value of money to put future expected money flows to use for projects started today. In other words, to put money to work in order to generate returns, undertake investments, or even create a market for money. Now that you are aware of the concept, let us move on to the main types of financing that are divided in 2 main types: debt financing and equity financing. Debt financing refers to when a business takes out loans from banks or other lenders, and it must be repaid, and usually with interest or collaterals. And if we talk about equity financing, it refers to when a business sells ownership stakes to investor in exchange for capital. The next slide is the activity proposed for the trainer to think, to compare, and share their insights of how the 2 main types of financing could bring to their local business. Moving on to the type of business or enterprises and their life cycle. MSME are businesses that are classified into 3 types: micro, small, and medium enterprises, based upon criteria set by each country, usually based on the annual turnover, the number of assets or wealth, and the numbers of employees owned. As every business is different, so as their life cycle and financing requirements. For example, start from the small business such as dry cleaners, medical clinics, mechanics, street vendors, which play a vital role in their local communities. Their business frequently aim to initially meet the owner personal or family income needs. And once the business are established and move on to another phase, the owner tend to place a greater emphasis on more than just making cash, making money, or maintaining their income, like to expanding, building branding connections, and reaching out to different source of funder who find their business desirable and profitable to partner with. In every business, there are startup phase, the growing phase, and the mature phase. The amount of growth and how long it takes to reach the growth vary. Business or company that are expanding quickly typically need more successive phases of financing at ever higher levels. Only a small percentage of entrepreneurial business make it through all these phases. Within a few years, many companies fail. Others are successful but are not given the chance to reach their full potential as they are acquired by bigger business. The first phase of business is called the startup phase. In this phase, the financing initially comes from personal sources such as personal saving, a second mortgage on the founder's home, which refer to the loans that you take out using your house as a collateral, while you still have, another loans secured by your house. The other source are like credit cards or lines of credits. In this phase, you may also start to seek for outside sources or seed investment that have such as loan from friends or relatives, bank loans from small banks and online lenders, short-term trade credits from suppliers, crowdfunding, equity investment from an accelerator programs. Business owners can attract investors to fund their business when they have a track record of business success, management team, and good standing in the business or scientific community. As you may be aware that no one will be interested in partnering with the weak growth potential business. In addition, there are some limited external sources of capital available to the startup-based business, known as the seed stage. When your bootstrap business starts to show some sign of success or growing, including trade credit. It is an agreement between two businesses allowing one business customer like to purchase goods or service from another supplier without paying cash upfront and instead pay at a later date. Trade credit is a better deal for the business owner than using a bank line of credit or another method that entails paying interest. Commercial bank loans may be able to provide some startup with limited financing. Crowdfunding, a method of raising capital through customers, families, friends, and investors on crowdfunding sites of platforms. Throughout the crowdfunding process, a business owner may use various platforms and crowdfunding sites to help raise capital. Accelerator offer fixed-term, cohort-based support for new company through financing, immersed educations, and customized mentorship in exchange for equity. The second phase of business is called the growing phase. As business expands itself and builds a larger customer base in its growing phase, more capital is in demand to expand the business operations, human resource, or possibly acquiring other small businesses. Your business may already be producing some positive cash flow that can be used to fund this initiative. But if your growth is strong or your strategy is to increase brand recognition, you will likely need more capital. However, now that your company has established its credibility, you can typically access external funding easier than in your startup phase. Most of that capital comes from bank debt for slow to moderate growth business. The capital source during this growing phase include internal cash flow from business operations, debt capital, which is the capital received from the local banks, for example. However, it is not easy to obtain when it comes to small business or startup. Banker would look to a borrower's ability to repay character, and collateral before making a loan. The other source is venture capital, which come from a private equity investor that provide capital to companies with high growth potential in exchange for an equity stake. Last but not least, the initial public offering, which refer to the process where companies sell their shares to the public to raise equity capital from the public investors. The process of IPO transforms a privately held company into a public company, for example, Meta Facebook. Moving on to the next slide. So the third phase of business is called the mature phase. In this phase, a business is no longer experiencing rapid expansions once it's reached maturity. Although growth is still possible in this phase, it might occur at a slower rate now that the owners have sizable market share. Owner may want to consider an exit strategy at this point. Owner may decide to keep running their business and collect dividends, or decide to sell it for profits. And once the business is credit worthy, additional external funds can be obtained in various ways, such as through bank loans, the sales of commercial paper, bonds, and preferred stocks. When we talk about financing, one of the guiding principles is that assets and their associated form of financing should be matched. Whether the funding is intended to launch a business, support or maintain its operations, or foster growth. The short-term assets should be financed with short-term financings, and long-term assets should be financed with long-term or permanent financing. If an asset's financing is shorter than the life of asset, the cash flow generated by the asset will likely not sufficient to pay off the loan before it matures, and the loan will have to be renewed or rolled over. Now let us move on to the second module, funding opportunity. Currently, there are more than 200 venture capitals and private equity firms, social impact investors, equity crowdfunding platform, and angel investors spread all over Southeast Asia. The general funding source that SME can turn to includes angel investors, venture capital, social impact investor, and equity crowdfunding. So what are angel investors? Usually, they are the affluent individual who provide capital for a business startup, usually in exchange for the convertible debts or ownership equity. The best way to find an angel investor is frequently through the contacts you have in the business community. There are also various websites online which you can reach angel investor even more effectively. So how about venture capital? Venture capital, similarly, it refers to the fund that invests in new or growing business in exchange for an ownership stake and often representation on the board of directors. The fund is made of investment from institutions and wealthy individuals. For the venture capital investor focus on the expansions, growth, and potential return from the business. They have a tendency to look for larger investments than angel investors do. Next source is a social impact investor, which refer to the business that looks to address significant issues in health, education, poverty, alleviations, or other social issues. This type of funders tends to have more flexible investment terms, which reflect the unique requirement of social enterprises. Some of the social impact organizations in the Southeast Asian markets have such as Aron, Garden Impact, Kiwa, etc. Last but not least, equity crowdfunding. Although it is still relatively new in these Asian regions, equity crowdfunding is becoming more and more popular. It gives business owners the chance to get funding through standard mechanism and give retail and other investors the chance to invest in new ventures. Moving on to the next slide, what are some of the Asian programs to assist MSME? We have ASEAN Coordinating Committee on Micro, Small and Medium Enterprises, ASME. That is the Asian body in charge of developing and promoting MSME. The second one is the Asian Strategic Action Plan for SME Development 2016 to 2025 was launched in 2015 to enhance the competitiveness and resilience of MSME to enable greater benefit from Asian economic integrations. ASEAN SME Service Center, an online platform to provide services to Asian SME and to create connection between SME and SME service provider. ASEAN SME Academy, an open access online training tool launched in 2014 to provide training course for SME and to provide business information relevant to regional SME as well as access to service provider to whom SME can reach out for finance advice, corporate programs, and networking. The other one is Asian Access. It is a free information portal for SME in the Asian region, launched on June 2021. This online portal provides comprehensive information on market and trade access in Asia and beyond. The other one is Asian Business Advisory Council, Asian BAC, established and launched in 2003 to provide private sectors feedbacks and guidance to boost Asians' effort toward economic integrations and to identify potential priority areas and issues by facilitating and strengthening regional economic cooperation and integrations. Last but not least, national programs, which are locally established to assist MSME. For example, in Cambodia, we have Khmer SME that was launched to be one-stop site for Cambodian business owners looking for information on starting, growing, and consolidating a business in Cambodia. Business owners can find practical answers to various business-related questions, ranging from official information on law and regulations, business networking and access to financing, up-to-date list of service providers, training opportunities, and even etc. Moving on to the next slide is the activity proposed for the trainer to think of their national programs and share their opinion on which national program are linked to ASME. Now let us move on to the third module of the course, which is establishing a funding plan. Micro, small, and medium enterprises, MSME, are an integral part of the economic development and growth in the Asian member states. By various definitions, Asia has 70 million MSME, accounting for 97.2% to 19.9% of the total number of enterprises, Micro-enterprises often represent the largest percentage. By region, MSME contribute 85% of employment, 44.8% of GDP, and 18% of the national export. MSME are defined based on criteria set by each ASEAN member state, which commonly involve sectors, number of employments, annual turnover, or total asset, etc. The next slide is comparing potential investors, which include bootstrapping, banks and other loans, credit cards, friends and family, angel investor, venture capital, and government. To understand each investor better, I'll go through one by one and compare the benefits and disadvantages each investor has offered. Bootstrapping. When we talk about bootstrapping, we refer to the practice of building a business without outside capital investment. It is to absolutely use our own capital or the personal finance. It comes with pros and cons. The pro is that the company has an absolute financial control and ownership, creative freedom on their business management, and flexible timelines, as there seems to be less pressure of returning the funds. However, it comes with personal and financial risks that the company and business will encounter. Bootstrapping also limits on your visibility, growth, and expansion, as there are no outsiders involved in, for example, decision making. Additionally, the company may have fewer resources and less credibility compared to those supported by external funding. Bank and other loans. This refers to the amount of capital borrowed for a set period within an agreed repayment schedule. When our business relies on banks or loans as a source of finance, it is beneficial in the term that the size of the loan and repayment period can be organized to match the firm's exact need, like the specific amount of cash a business needs to run their business. And it also has favorable interest rate for specific SME. The most advantageous is that it provides no equity dilutions compared to that of venture capital or angel investors. However, accessing to bank loans comes with a price. Usually, there are strict eligible criteria, for example, the requirement of collateral, complicated application procedure, high interest rates, and the risk of seizing or losing assets when the company encounters financial struggles or crisis in paying the loans. Credit cards also comes with pros and cons. The business owner can easily earn rewards, build credit history, access to digital tools and account management, access to cash flow, and financial flexibility, predictable payment schedule, and to quickly access to emergency funds. However, the credit cards user may have to pay high interest rates. There's also some unforeseen hidden costs and likely to be exposed to theft or fraud. Most importantly, you need to have a safely deposit before being able to use one. The other could be friends and family. This is one of the quickest funding alternative in which you have a high percentage of positive response from them. In addition, the repayment condition is also flexible, and there are no need for collateral in obtaining the loan from them. Still, there is a high chance of a breach of trust, a breach of contract, and the loans are very limited. Plus, if it does not work well, that could cause, a major strains on personal relationship as well. The other alternative is an angel investor, usually for startup or early stage business. Angel investors come from wealthy individuals who use their own money to make equity investments in early stage companies. Some angels are tech entrepreneurs, others are successful doctors, lawyers, real estate developers, entertainers, personal athletes, etc. The pro is that it provides secure funding without interest payment, provide a lot more than just money, including industry expertise and a strong network of connections. It also helps in attracting other investments as well. Nevertheless, they need to have a contract, slow, careful cultivations, less control of ownerships, and certain decisions sometimes need to follow, individual investment approach of the angel investors, and the documents and compliance requirements are also, complicated, and business owners need to bear with their confidential information sharings. Venture capital refers to the fund that invests in new or growing business in exchange for an ownership stake and often representation on the board of directors. The fund is made up of investments from institutions or wealthy individuals. By getting venture capital as the funder, business owner may potentially obtain large sums of money for investments, get access to more than just cash, but also the industry expertise and a strong network of connections, similar to that of the angel investors. By having backup by the venture capital, business owner can attract other sources of finance as well, and the opportunity for an expansion of company is relatively high. Nonetheless, venture capital is not easy to persuade or to convince. And once you are with the venture capital, they would interfere in your business management and decision making, as you have already made equity investments in your business with them. Additionally, venture capital does not just easily accessible. It usually be offered to trusted SME in their networks. And business owners also find it hard to access to the information about financial channel and lacks of awareness on how to approach and deal with them. Last but not least, the government. It is the fund from a local authority aimed at providing public support and stimulating the economy. Usually, grants are awarded to finance or reimburse activity that meet the government priority and objective. Government funding is widely available for SME, and it is a great financial assistance to help business grow and succeed. By accessing to this type of funding, business owner can increase their visibility, such as helping you attract new customer or clients, as well as increasing your chance of being featured in the media. And enhance credibility, such as by making it easier to obtain loans and other forms of financings in the future. This type of financings also provide low interest rates and keep business afloat during economic crisis as well. For example, they provide tax incentives and other benefits specifically for SME. Nevertheless, the application process to obtain this funding is relatively slow and detailed. Plus, certain requirements must be met and is highly dependent on the government policy. They also come with extensive monitoring, evaluation, and reporting, and the funding availability is very limited. The next slide is the activity proposed for the trainers to think of the potential investor they consider would be the best match for their local business. So all in all, every business needs financing in order to grow and to unleash their potential. Throughout the journey, they have to go through 3 key phases, which include the startup phase, the growing phase, and the mature phase. In order to obtain funds, business owner can choose the type of funders they think will be best suited to their business by considering all the aspects as described in this course, and to ensure that they have the knowledge of where and who to went to when the business starts. Now that the course has come to an end, thank you for your attention to this course. And so there'll be any questions or concerns, please kindly reach me out through my emails. And I am looking forward to your comments and will be delighted to assist you in the future endeavor. Thank you.